Hey everyone, and welcome. So, if you think tax saving is just about that mad rush to make investments in March, you are going to want to stick around. Today, we're diving deep into some genuinely smart, totally legal, and powerful ways to slash your tax bill here in India.
But first, let's get some perspective. Look at this number, 2.2%. That's the shockingly tiny fraction of India's entire population that actually pays direct income tax. So what does that mean? It means the burden falls incredibly heavily on a very small group of people, especially those of us with a salary. It's why it can feel like 3 or even 4 months of your hard-earned salary just disappears into taxes. But you know what? It really doesn't have to be that way.
All right, let's start at the very beginning with the single most important decision you have to make every single financial year. It all starts right here, choosing your tax regime. This one choice, it sets the entire stage for every other saving strategy you're going to use.
So what's the deal with these two? Well, think of the old regime as the classic all-inclusive option. It's got over 50 different deductions and exemptions you can use. It's like having a big toolbox to lower your taxable income, but the tax rates themselves are a bit higher. The new regime, on the other hand, is all about simplicity. It scraps most of those deductions, but in return gives you much more favorable, lower tax slabs.
This really is the million-rupee question, isn't it? Every year, people get so confused about this. But guess what? Finding the answer is actually surprisingly simple. In fact, you can probably figure it out in less than a minute.
Okay, here's the quick rule of thumb. Just add up all the deductions you think you can claim. For most people earning a good salary, the break-even point is somewhere around 8 to 9 lakhs in total deductions. If you can claim more than that, the old regime is almost definitely your winner. If you can't, the new regime is probably going to save you a lot more money. It's a fantastic starting point.
Okay, so once you've got that foundation sorted, let's talk about the easy wins. I call them the everyday wins because some of the most powerful deductions don't come from complicated investments. They come straight from your life. And let's start with what is probably the biggest expense for most of us, rent. Now, you have got to hear this one. It's an incredible hack that is 100% legal. If you live with your parents and they own the house, you can actually pay them rent and claim your full house rent allowance or HRA benefits. So instead of just sending them money to help out, you structure it as rent, and you can end up saving a ton of money on your taxes. Now, to do this completely by the book, there are 3 things you absolutely must do. First, get a formal notarized rent agreement made. Second, you have to actually transfer the money to their bank account every single month. A paper trail is key. And third, just remember that rent you pay is technically taxable income for your parents. But since they're often in a much lower tax bracket, it usually works out as a huge net win for the whole family. And speaking of homes, here's a seriously powerful strategy for working couples. If you take out a joint home loan, you can basically double your benefits. I mean, each of you can claim deductions on both the principal and the interest. That can lead to a massive combined deduction of up to 7 lakh rupees a year. Now that gets you way closer to making the old regime worth it.
This might just be the single most powerful deduction that so many people just don't know about. Under Section 80E, the interest you pay on a higher education loan, whether it's for you, your spouse, or your kids, is fully 100% deductible. And get this, there is no upper limit, no cap, none. You can claim the entire interest amount for up to 8 years. It's huge.
All right, we've covered the fundamentals, the solid everyday wins. Now let's level up. Let's get into some of the next level strategies, the kind of hacks the real pros use to save big time. I know, it sounds a little crazy, right? But can getting married actually be a tax hack? The answer, believe it or not, is a big yes. Marriage gives you this unique, once-in-a-lifetime opportunity for tax saving that you just don't get at any other time. Here's how it works. On the occasion of your wedding, you can receive unlimited gifts of any value. We're talking cash, cars, even property. And it can be from absolutely anyone. Relatives, friends, your boss, doesn't matter. It's all completely tax-free. See, normally, gifts from non-relatives over 50,000 rupees are taxable. But at your wedding, the sky is literally the limit. Okay, prepare yourself, because this one is a true game changer. What if I told you that you could get a brand new 20 lakh rupee SUV for an effective price of just 10 lakhs? It sounds impossible, but it is absolutely possible, and it's 100% legal through something called a car lease policy offered by your employer. So how on earth does this work? It all comes down to when the money is spent. If you take a car loan, you pay the EMI from your salary after the government has already taken its taxes. But with a lease, your employer pays the lease rental before any tax is deducted from your salary. That's the secret. On top of that, your fuel costs and even your driver's salary can become tax deductible. If you just look at the comparison, over 4 years, the tax you save can be over 13 lakh rupees, effectively cutting the cost of that car in half. It's incredible.
Now, let's shift gears. So far, we've focused on saving tax on your salary. But now, let's talk about saving tax on your investments. This is where you really move from just saving money to actively building wealth in the most tax-efficient way possible.
One of the smartest techniques out there is called profit harvesting. You see, the government gives you a gift every year. You can earn up to 1 lakh rupees in long-term capital gains from stocks and equity funds completely tax-free. Profit harvesting is simply the strategy of making sure you use this gift year after year.
And it's so simple to do. Here's how it works. It's like a little 3-step dance at the end of the financial year. Step 1. You sell just enough of your stocks or funds to book a long-term profit of up to 1 lakh rupees. Step 2. You immediately reinvest that same amount of money. Step 3. This action resets your purchase price to a new, higher value. By doing this every year, you basically pull out your tax-free gains and prevent a huge taxable profit from building up down the line.
But what happens when the markets are down? Well, you can actually turn those losses into a win with something called tax loss harvesting. Let's say you have a profit in one investment, like gold. You could then sell another investment that's making a loss, like a particular stock. That loss from the stock can be set off against the gain from the gold, which can bring your overall taxable profit all the way down to zero. It's about being strategic in both good times and bad. As we get ready to wrap this up, I want to talk about the single most important tax hack of all. And you know what? It's not a section in the tax code. It's not a loophole. It's a fundamental shift in your mindset.
Think about it. The wealthiest people in the country and the average person are all governed by the exact same tax laws. The key difference is that most of us just file our taxes once a year. The smart ones, they plan for it all year round. Filing is just compliance. It's a chore. Planning is a strategy.
So you see, the tax code isn't just a boring set of rules you have to follow. It's a playbook, and it is filled with opportunities and secrets waiting to be unlocked. So the only real question is, which one are you going to unlock to your advantage this year? Thanks for joining me.